$22,000. That's the tax bill on a sale that never happened. Let's talk about Sarah, who did not sell any share. She did not cash anything out. She just took a job in Dubai, and on the day she stopped being a Canadian resident, the CRA treated part of her investment portfolio as if she had sold the entire portfolio. Her investments had grown by $100,000. That gain went on to her final Canadian tax return, and the resulting tax bill was about $22,000. The problem is that Sarah never received the money. Her investments are still sitting in the market, but the tax bill is real, which was caused by the departure tax CRA charges you. The easiest way to understand departure tax is to treat it like the CRA's exit interview. 4 questions decide almost everything here. What does the CRA say you sold? What was it worth when you left? What do you have to file? And when does the tax actually have to be paid? So let's start with question 1. What exactly does the CRA say Sarah sold? Before the CRA can calculate anything, it needs to establish this one date, the day Sarah stopped being a Canadian resident. That date matters because every asset caught by the departure tax is valued on that particular day, and it is not necessarily the date Sarah gets on a plane. Generally, your departure date is based on 3 things: when you leave Canada, when your spouse and children leave, and when you become a resident of the new country. Your actual residency still depends on the facts and the ties you keep in Canada, which I've covered in detail in my video on how the CRA knows you left Canada. Once that departure date is established, the departure tax rule kicks in. The CRA treats Sarah as if she sold certain assets at their fair market value immediately before she stopped being a Canadian resident. Then, for tax purposes, she is treated as buying them back at the same value. Nothing actually gets sold. Her investments stay exactly where they are, but on her Canadian tax return, a sale has happened. Now, we need to figure out which of Sarah's assets are actually caught under this departure tax rule. So let's say Sarah owns a condo in Toronto and she plans to rent it out. She also has an RRSP, a TFSA, and $200,000 in a non-registered investment account. So the Toronto condo is excluded from the departure tax because Canadian real estate is not subject to this deemed sale. Her RRSP and TFSA are excluded as well. The same generally applies to accounts like RESPs and RDSPs, pensions, and certain employee stock options. Her non-registered investment account is different. The stocks, ETFs, and mutual funds inside the non-registered investment account are caught by the departure tax. Crypto can be caught too. Shares of a private company can be caught, and foreign real estate can also be caught. This last one surprises a lot of people. A condo Sarah owns in Toronto is excluded. But if she owned a condo in Florida instead, that foreign property could fall directly into the departure tax calculation. The assets excluded here are not necessarily tax-free forever. Canada simply deals with many of them under different rules once you become a non-resident. And we will come back to that at the end. There is also one important exception. If you were a Canadian resident for 60 months or less, during the 10 years before you leave, property you already owned when you first became a Canadian resident can generally be excluded from departure tax. Property you inherited while you were living in Canada can also qualify for this treatment. So someone who moved to Canada for work, stayed for 4 years, and then moved back home could have a very different departure tax calculation from someone who lived here for 20 years. For Sarah though, question 1 has a simple answer. Her Toronto condo, RRSP, and TFSA are out. Her non-registered brokerage account is in. So then the question 2 becomes what Sarah's account is worth. And this is where the tax bill is actually created. On the day Sarah left Canada, her brokerage account was worth $200,000. She had originally paid about $100,000 for those investments. So she had a gain of $100,000. With a 50% capital gains inclusion rate, $50,000 gets added to her taxable income for the year. And because Sarah had already earned about $120,000 of salary before leaving, that gain lands on top of the income she had already earned. For our Ontario example, that produces a departure tax bill of roughly $22,000. That exact amount will be different for everyone. Your province, your other income deductions, and any capital losses you have available can all change the final number. But for Sarah, $22,000 is a reasonable estimate. So now think about it. She has $100,000 of investment growth and roughly $22,000 of tax on that growth that she never actually cashed out. Now, to make this calculation, the CRA really needs two numbers: what the asset was worth when you left Canada and what you originally paid for it. The first number is usually easy. You can look at your brokerage account and see what the investments were worth around your departure date. The second number can be much harder. Your adjusted cost base may go back 10 or 15 years. It can include multiple purchases, reinvested distributions, account transfers, and records from brokerages you may no longer use. And this is where people get stuck. They leave Canada first, then months later start trying to rebuild years of investment records from another country. So if a move is coming, start collecting those records before you leave. There are also two situations where I would just get professional help. If you own shares in a private company, you may need a proper valuation to support what those shares were worth when you left. And if you are moving to another country, you also want to understand how that country will treat the new Canadian tax cost of your investments. Canada may reset your cost to the departure day value, but the new country may use a different starting point, which can create a tax issue later in that country. So the departure date tells the CRA when to measure everything, but your records determine the number that goes onto the tax returns. So in our example, Sarah now has her number, roughly $22,000. Later in this video, I will show you how the same portfolio can produce a very different tax bill when the real facts of the move put the departure in a different tax year. But first, Sarah has to report all of this properly because the paperwork creates a completely separate set of problems. This brings us to the question 3. What do you have to actually file? There are two forms you need to understand here, and they do completely different jobs. The first is Form T1243. It takes the assets caught by the deemed sale, works out the capital gains or losses, and carries those amounts onto your final Canadian tax return. The second form is T1161, and this one catches people for a completely different reason. If the total market value of certain property you own when you leave Canada is more than $25,000, you may have to give CRA a list of that property. $25,000. Not $200,000, and that number is only a reporting threshold. It does not mean the first $25,000 is exempt from departure tax. Certain things are excluded from the calculation. Cash is excluded, registered accounts are excluded, and personal use property worth less than $10,000 per item is generally excluded as well. The important part is that T1161 does not calculate any tax. You can owe $0 of departure tax and still be required to file this form. And the funny thing is that if you miss this, even with zero departure tax, the penalty is $25 a day with a minimum of $100 and a maximum of $2,500. That is why this form causes problems. Someone can correctly calculate that they owe no departure tax, decide that there is nothing to file, and still end up with a penalty because the reporting requirement was separate. I have seen careful people get the tax calculation right and still miss this form because it looks like a simple information schedule. So if you are leaving Canada, do not use "I don't owe any tax" as a reason to ignore T1161. The filing requirement has to be checked separately. At this point, Sarah has done two things. She has calculated the departure tax gain and she has reported what the CRA needs to see. But she still has the original problem. She owes roughly $22,000 on investments she never actually sold. And that takes us to question 4, because calculating the tax and paying the tax are two different things. So question 4 is when the tax actually has to be paid. Sarah's real problem was never whether she owed the tax. Her problem was when would she need to pay it. The CRA is taxing growth that is still sitting inside her investments. So if Sarah has to pay $22,000 today, she either has to sell investments she never planned to sell in the first place or find the money somewhere else. But then there's another option, Form 1244. Let Sarah elect to defer the departure tax until she actually sells the investments. So instead of paying $22,000 now, she can keep the investments and generally wait until the real sale happens before paying the deferred tax. But this election has a deadline. It generally has to be made by April 30th of the year after you leave Canada. Miss that deadline and you can lose the ability to defer the payment. There is also an extra requirement once the tax gets large enough. If the federal portion of your departure tax is more than $16,500, the CRA can require acceptable security for the deferred amount. So in our example, Sarah stays below that line. Her federal share is about $13,000 of the entire $22,000 total bill. So she can make the election without posting a security. Someone with a larger departure gain can cross the threshold, and at that point the CRA may require a security, which can mean pledging the very investments that created the tax bill in the first place. There is also a rule for people who eventually move back to Canada. So if you return and still own the property that was subject to the deemed sale, you may be able to ask the CRA to unwind that earlier departure tax calculation. That can reduce the tax and, where applicable, release security that was posted. But for Sarah, the immediate problem is solved. She files the election by the deadline and keeps her $22,000 in her pocket until she actually sells the investments. The tax bill did not disappear. The payment date moved. And that completes the CRA's exit interview. 4 questions, 4 answers. But there is one more thing Sarah should have understood before any of this happened, because the size of that $22,000 was not inevitable. It depended heavily on when her departure date fell in the tax year. So let's talk about the part that you can actually plan. Sarah left Canada in December. That matters because her $50,000 of taxable capital gain landed on top of almost a full year of salary in Canada. She had already earned about $120,000, so much of that gain was taxed at a relatively high marginal rates. Now take the same Sarah under a different set of real circumstances. Her new job starts in January instead of December. The family's lease runs to the end of the month and they all move together in the first week of January. Now Sarah has earned almost nothing in Canada during the new tax year. The same $100,000 capital gain still exists. $50,000 is still included in a taxable income, but instead of landing on top of a full year's salary, that taxable gain starts much lower in the tax brackets. Same portfolio, same $100,000 gain, but now the tax bill is roughly $9,500 instead of $22,000. That already factors in the fact that some of Sarah's personal tax credits are reduced because she was only a resident for a small part of the year. The difference between the two scenarios is roughly $12,500. Your departure date follows the facts: where your family lives, what happens to your home, when your significant ties to Canada change, and when you become resident somewhere else. All of this matters. But some people genuinely have a flexibility around when a new job starts, when their family moves, or when they establish residency in the new country. If your real circumstances could place your departure on either side of December 31st, you should know what that difference is worth. That is where tax planning before you leave can pay for itself very quickly. But do remember that everything in this video is general information, not advice for your situation. So before your departure date is fixed, run the numbers while you still have choices. The goal isn't to find a clever flight date. The goal is to know what leaving Canada is going to cost you before the tax result becomes permanent. And the assets that weren't caught by the departure tax today still change once you become a non-resident. Your house, your RRSP and your TFSA each move under a different set of Canadian tax rules. And one of those rules can cost you money every year if you're away. That's the next video on your screen now.